my video, we're gonna cover some basic stuff, but we want to get into practical. You know, yes, these loans do this, but you know, every day you guys have, you're meeting with buyers who either come to you and say, well, you know, the lender said I couldn't do this, or I don't think I can qualify for that. The quality of your questions that you can ask them could take a person who thinks that they're not qualified or even wasn't qualified from one lender into a loan and a purchase with you. So you don't have to be an expert, but you need to be able to think outside the box. And knowing the basics and the practical usage for some of these products will help you get there. One of the big things, just starting with conventional, it's surprising how many people still think you need 20% down, right? Tim, broker over at Summerlin, kid was living in his house, and he went to him and says, I'm a realtor, why aren't you buying your own place? And he looked at him and said, I don't have 20% to put down. That's how overlooked it is. We assume that everybody knows you can put how much down on a conventional?
3.5. Is it 3.5?
FHA is 3.5.
Okay.
Get that.
5%.
5%. Now, it's tricky. They say 3%, but if you get someone who qualifies for the home ready, which is 3% down conventional, it has to be, they have to make under the area median, 80% of the area median income, which we're talking $70,000 here in Clark County. What's that going to get them?
Not much.
Under 350 if they don't have any other debt, right? So that one's kind of in the wind. You know, we will find a unicorn that fits it here and there, but 5% usually. USDA, anybody done in USDA hire? More like out in Pahrump, on the outskirts. Most of the stuff in Las Vegas, there's no USDA. How much down for a USDA loan? 0%, right? Tricky thing about USDA loans is they are super strict on their debt to income. So there is no limit on a USDA loan, right? But there are income limits per household. And there is a DTI window that is tighter than any other loan out there. So in essence, if they make up to 120,000, let's say, they can qualify as long as their debt to income stays in the 30s. Okay? They're somewhat flexible, but not very. You have to have something we call compensating factors. And this works across all loans. You have great credit, awesome, that's gonna compensate for something. You have a lot of money in the bank, reserves, awesome, that can compensate for not such great credit. Low debt to income, all of these things can compensate. So if, for instance, you know, on the conventional side, there's two primary purchasers of these loans. We got Fannie and we got Freddie, all right? Both of them have different algorithms in their automating underwriting system. And I couldn't tell you what they were. You just keep playing with it until it says approved. But what I have found is Freddie will allow you to get all the way up to 49% on front end, 49% on back end, and qualify. When I say front end DTI, what is that?
Debt to raise.
Debt to income, but what is it calculating?
Just the income versus the, what, front end?
Yeah, front end.
Front is the, oh gosh, I've been out for 9 months, so, oof. Just the income versus the housing.
Yep,
Sorry.
housing only.
Yeah. and then the-
HOA, taxes, insurance, mortgage payment. So it's covering all of those things. Back end includes your front end plus anything that shows up on the credit report or anything that the underwriter finds on your bank statements that's reoccurring, okay? So as a lender, I have to go through and make sure none of that's gonna pop up, because that will happen at the end of the deal. When we're about to close, underwriter gets a new bank statement, and they're like, wait a minute, this charge has happened 3 times over the past 3 statements. I need to ask, what is $150 a month? Because it's not on your credit report. I might have to add that, and it could kill your DTI. All right, well, it was little Jimmy. I pay him $150 a month to mow my lawn. Okay, cool. We're not gonna include that. Or it was, let's say, nowadays, DirecTV or Dish or anything like that. We can get around that. But if those show up, they'll ask questions. So back end DTI. So if this person has a 49 and a 49, what does that mean?
What do you mean?
They have no debt, right? 49 front end, 49 back end, that means all housing costs. Fannie Mae doesn't like that, right? Fannie Mae doesn't want to see anything over 42% front end, no matter what the compensating factors. All right, Freddie may have saw 700 plus credit score, 3 months reserves, and they're like, okay, I'll approve 49, 49. All right, so on our side, that's where we have to get creative. So there's no real set thing of, you know, all right, because every deal is definitely case by case. Back to USDA, that's 0% down, no MI, but there is a 1% fund fee, every annual fee that's worked into the loan. Every year you have it, there's 1%. FHA does not stand for first-time home buyers. Everybody thinks that, I swear. And they're like, well, I'm a first-time home buyer. Can I do that FHA? I'm like, do you want to? What's the difference between FHA and conventional?
Just PMI.
Yeah, PMI. This is crazy. So there's two things you need to know. PMI is an upfront mortgage premium, and it's at a rate of 1.75%. So how much down do you have to put on FHA? 3.5. Then you got a 1.75% upfront premium. Now where are we at? We're over 5%. Now with FHA, they'll put that in the loan. They'll put that 1.75 into the loan. That's okay. But when we're talking about costs, you know, FHA may have lower rates, but the cost of the loan is more expensive than a conventional. So on top of that mortgage premium, you're getting a monthly mortgage insurance. What's the difference between FHA and conventional on the monthly?
Well, usually the conventional, I would think, would be lower because of the fact you're putting 20%.
Well, you're good. FHA is set at 0.55% unless you put more down.
Right.
Conventional, it depends on the different contractors, the third-party mortgage insurance companies, and they look at credit, debt to income, reserves, all of that to assess how much percentage you're gonna pay. So if you got great credit, you could be down in the 0.2, 28% or 30% and lower. But the big difference between conventional and FHA on the monthly mortgage insurance is FHA is for the life of the loan. You could have 30% equity and you're still paying mortgage insurance. You could put 40% down when you purchase, whether an FHA, and still pay mortgage insurance. But with conventional, once you hit 20% equity and you have 80% loan to value, that mortgage insurance can go away. You'll have to call them and start the process. I wouldn't wait for it to drop off, okay? So notify them. So why would someone put 40% down and use an FHA?
You get a conventional loan, and then just as you say, look.
Right, why not?
You get the, once you get that percentage, you can drop off that PMI and
Yeah.
drop your payment.
I'd totally go conventional if I had 40% down.
Yeah.
But what if I had to go FHA? Why would I have to go FHA?
Credit, or.
Credit. I mean, if you're putting 40% down on a conventional and you got a 640 credit score, you're not gonna get hurt that bad on your rate.
Right.
All right, a lot of those loan level price adjustments go away with 40% down. But some of the big things is, what about bankruptcy?
Yeah.
All right, typically it takes 2 years, you know, to get a FHA loan after bankruptcy, after discharge, not filing. And that is a tricky part. Everybody thinks, oh, my bankruptcy was in March of 2022. We're good to go. Well, they might have been done in March 2022, and it might have sat in the system or somebody's desk for another 3 months before it got stamped and discharged. Now all of a sudden we're April, May, June, and that could kill a deal. So those are things we need to look at. When we get into the non-QM, there are ways around these timelines with other products. Anybody deal with manufactured homes? Yeah, some. You will. It will happen, but they're not scary. Biggest thing is, it's gotta be affixed to the ground for us to loan on it. Can't be in a trailer park on wheels. Once it's affixed to the ground, it's just like any other, you know, loan. We can do single wides, we can do double wide. There is an age limit, 1976, gotta be newer than 76 to loan on.
How about its first home,
First home, we can,
meaning it came from manufacturer, it can't be moved?
that's key, it cannot be moved. So like, here's something that can be found and could disrupt the deal. Let's say manufacturer went out of business and he moved all of his finished product from one lot to another lot who purchased everything. And then that guy sells it to somebody who goes out and puts it on dirt. Maybe they did cash. Maybe they did some sort of weird financing to get it done. Then you come in, it's like, oh my gosh, I'm gonna buy this sweet home on an acre, put an offer in, and somehow the underwriter figures this out. They will. Don't know how. I would never be an underwriter because I wouldn't care and I wouldn't look for it, right? But they find out that, hey, this one's been moved twice. Can't be loaned on. So that's something to look out for. The certificate, that's simple. Usually there is a certificate of affixation that title can pull up as soon as the appraiser gets them the data tag information there.
Is it the 433 still for?
Yeah. So manufactured, not scary. Sometimes you just have to do it. Talked a little bit about jumbo loans. Again, these are banks loaning their Chase is a big player in the jumbo world.
John, real quick, just so people don't know, what exactly is a jumbo loan considered?
Jumbo is anything over the conventional limit. And right now the conventional limit is, anybody know?
FHA, I don't
Is
think
it
that's
625, 800?
766.
Oh.
Yeah. So anything over 766 considered jumbo. We don't wanna do jumbo if we don't have to, right? So if someone comes in and let's say it's a $1 million home, and if they were to put 20% down, it only takes it down to 800,000. We're still over the limit. So what we would do there is we'd either beg them to put another 34,000 down, or we would say, all right, we can do two things. I can give you a piggyback of 34,000, just a second loan, right? Or if you want to keep some of your money in your pocket, just put 15% down, and I'll give you a piggyback of 84,000. It still covers the fact that we got 20% down on the home, all right? Back in the day, they used to do these all the time, right? Nobody wanted to pay mortgage insurance, so they put 5% down and get a 15% second, okay? Got away from that. Probably because the rates and everything made it higher to pay than the actual mortgage
So
insurance.
is it the jumbo you don't wanna do because of the interest rate? Is that the biggest thing, or is it just more of a everything?
Everything. There's stricter guidelines.
Okay.
A lot of times, especially if you're dealing with Chase or one of these banks, you have to stick with their guidelines. They may even have to underwrite it depending on the product. Whereas a lot of times we can get away on a conventional, you know, here's a good one. tax returns for businesses, self-employed. If you've been employed for 5 years or more, we only need to see 1 year. Whereas if you did a jumbo, they're gonna wanna see both years anyway.
Okay.
So, this happens a lot, is so-and-so had a much better year, where we just crossed over into 2024, 2023 was great, and he wants to use 2023, so we hurry up and submit 2023 taxes, and we go under contract, and we just use that year because it was a great year and they've been in business for 5 years. So we get more flexibility outside of jumbo world.
Okay.
If you're up over 1.2, 1.4, we're just gonna do jumbo, and we're gonna find the best product, and we do the best we can. So, but, we were listening to a, thing this morning from Barry Habib, and he was mentioning how many homes are going over 1 million. How many purchases?
Habib?
Huh?
Who's Barry Habib?
Right? Barry Habib is our dude, our medium,
He's
you know.
the Jesus of mortgage.
Yes, I didn't want to go there, but he is.
Hey,
If anybody's got a crystal ball, it's him.
100%.
He's right way more than anybody else.
Didn't he get named like the little crystal?
He has won the crystal ball
winner?
every single year
Yeah.
in the financial sector. And he basically tells us where this market's going so that we can stand up in front of you and be confident in what the rates are doing and why. And that's the key, is why. Understanding why the rates are moving, why the economy is doing what it's doing, why the job numbers are wrong, you know, and understanding what's affecting the market. So, but he talked today, he's like, hey, over, the last 5 years, the amount of homes that sold for over $1 million doubled. So it went from 4% to 8%. 8%. In 5 years, it doubled. Okay? It's gonna double again, probably less than 5 years, because it's just exponential at this point. The market's moving. You don't think these $800,000 homes are gonna be worth $1 million next year? You bet your butt they are, because as soon as the inventory shrinks and all they start building is $600,000 and up, yeah, it's probably gonna be 13, 14% in 5 years. Okay? So, jumbos are not going away. There'll probably be a higher need for it. The minimum or the maximum conventional loan limit will keep increasing, same with the FHA, but they probably won't keep pace with crazy markets where
Right.
prices shoot up. All right, I think the last 2 years it shot up more than I've ever seen it. Those limits jumped quite a bit.
Well, yeah, because FHA is like 479, is that something like that, am I right?
It's county specific.
Yeah.
Yeah, and I want to say we're right there at 490. We're just under 500,000.
Okay.
Yeah, and that's loan amount. Remember, 766 loan amount. So you can buy $1 million home and put 234,000 down and still be a conventional loan. It's the loan amount. You can buy a $600,000 loan home on FHA and put 100,000 down and still be
Right.
FHA.
Right.
So that's just basically on the loan amount. But jumbo loans up to 3 million. Some cases can go higher. Just depends on the product. VA. VA is fun. I love VA. We get a lot of flexibility. VA is 100% loan, 0 down. Okay. There is a funding fee on VA loans, and if you are disabled or receiving any type of disability, you can get that funding fee waived. And it increases each time you use it. If it's not waived, if you don't have that disability designations and it's not waived, you can use it multiple times, right? There's a myth that you can only use it one time. Not only can you use it more than one time, can you use it on multiple loans at the same time? Yeah. Okay. Simple rule of thumb, your eligibility is gonna run with, let's say, the conventional loan limit, all right, 766. So if you bought a home and your loan is $350 and it's a VA loan, how much eligibility do you have left?
Right.
Another 400,000.
Right.
That's ballpark. There's some overcomplicated math equation that will spit out probably the same number, but that's a simple term. Okay, so you could have two loans as long as you're under that 760, and if you do go above it, then there's another complicated mathematical equation that tells you how much you have to put down, but you could still do another VA loan. What's,
And it's residual driven.
yeah, especially if they're still active duty. What's the loan limit?
None.
What's max loan limit for VA?
No, it's based off of what you can afford.
Yeah, absolutely. If you have 100% of your eligibility, there's no limit as long as you can afford it. And the cool thing about VA is their debt to income ratios. I've qualified and approved people in the 60%.
Wow.
Are you serious?
Yeah, as long as that residual income, as long as all these other complicated mathematical equations in the background make sense, yeah, you got a lot more flexibility with
Oh,
VA.
wow.
Refinances, believe it or not, that's gonna happen, we're going into a refinance boom. Here's the thing, you're gonna come across clients who are gonna be hell-bent on not selling their house because they got a 2.5% rate.
Facts.
I don't blame them. I wouldn't either. If they're smart and they're, focused on building wealth, absolutely not. Turn that sucker into a rental because it's super easy to get cash flow on a home with a 2.5% rate. The beautiful thing about it is, let's say you live there for a year. And you're like, you know what? This home's too small. I wanna buy another one. You can go buy another primary home, get a primary residence rate, and you get to keep your 2.5 on the other one. They don't change your rate just because you left there and you're gonna turn it into a rental,
Wow.
okay? Year later, you get tired of that one. Say, I want a bigger yard. I'm gonna move across town over here, buy another house. Primary residence, primary rate. Got a primary rate on the other one, all right? If you refinance it, you're gonna have to refinance it at an investment rate. So make sure it's a comfortable place before you leave it. You can do this as many times as you want. And you can leave a path of wealth behind you.
And that's what conventional over here.
In VA, you'll have to, at least for the first one, you'll have to get an actual property manager. They wanna see proof of either you've done this before or that you're gonna have a professional manage it.
Which you should be doing anyways.
Yeah.
So, one thing that's not on here, multifamily. FHA is probably the best loan for multifamily, but what do you have to do with FHA if you're buying a triplex?
Live in one.
Reserves.
No, you have to live in one.
You have to live in one of them, don't you?
FHA is only for primary. You can't do an FHA on an investment or second home. And in fact, you can only have one FHA, unlike VA, you can only have one FHA loan at a time. And you really have to fight to get a second one. You have to have a darn good reason to move at least 100 miles away and have to get another FHA loan.
Wow.
So, FHA loan, triplex, low rate, 3.5% down. Now all of a sudden, if it's a triplex, shoot, now my loan limit's up over $1 million. I can do $1 million on a triplex with an FHA. As long as I'm living in one. Live in one, remodel it, move into the next one, remodel it, move in, whatever. But FHA is going to make sure you're living in one of them. But that's great. That's a good way to start building your wealth, is to buy a triplex and live in one. Then move out there. So refinances, again, a lot of people have bought in these past year. You guys sold homes, right, in the past year? So a lot of them are in the 7s, most of them. We're in the 6s right now. I'm already doing refis right now. The other thing is some of these 2s and 3s will refi. Because what happened in the past year?
Equity.
Equity didn't go up as much.
Appreciation.
But what happened to them personally?
Their savings went bye-bye.
Yeah, that COVID savings account is gone. And they replaced it with what? Massive credit card
Yes.
debt. And I just did this for a
Almost
realtor.
$2 trillion.
Yeah, realtor buddy of mine, investment home. He wants to get a HELOC. His first is like $60,000 on a 3.8%. He's like, I just want a HELOC. I'm like, how much do you need? He's like,
All of it.
Oh, that's funny, because it turned into a lot more after we started talking. But he only wanted like 20 or 30,000 at the time. And all I did is like, okay, let's do a math problem. And it turned out that this first was a 3.8 for 60, and we got all the way to $60,000 on the second at almost 10% on a HELOC. I'm like, I could actually do a full refinance for you at 7, and you're saving money
Right.
monthly. But what did he do with that money? Paid off all his credit cards. His high interest car loan.
Payments need.
Gosh, you wanna find someone in massive debt. Anybody who bought a car in the past year, that's deadly. So, these are reasons that they'll do the refinance. And the cool thing about refinancing is we can pay all those things off at close and qualify them now based on them not having any debt and get it closed.
Gotcha.
That's important. Condotel, there are some of these situations, we have our own condo department that's really good. In fact, I just did one recently in Florida, and they said that, the listing agent said, nope, they're gonna put 30% down. There's no way that it'll go, we've tried, it's just not approved through Fannie or Freddie. And this person was another agent, I do a lot of loans for agents. This person was buying an investment home, second home. I'm like, well, with our portfolio product, we can do 15% down on a second and get you a smoking rate. I said, let's talk to the listing agent and have them give us a shot. Like, let's put it through as a 15% down, regular conventional, and we'll try and get the approval. And if not, we have the in-house non-warrantable condo product, we'll just switch it. The difference for you is either you're putting 30% down or 50% down with a lower rate. So they gave us, all right, you got 45 days to get this done. We closed it in 30 on a conventional. Our condo department got that sucker approved, full approval. And now it's like, okay, so we can go through and let everybody in that condo complex know that this place is approved now.
Right.
So it really does matter who you work with in their condo department when it gets to those.
And a question for you, because not everyone finances own condos. You saying you have a separate department that will, and under the conditions that it is pre-approved that you can loan on a condo in it.
All condos have to go through condo approval.
Okay.
Even the ones that are approved, we have to make sure, we still have to send out a questionnaire and make sure their books are still good, right? So every condo has to be approved. It's called a condo questionnaire, condo cert, all kinds of different names for it. But that condo department is internal. Every big lender should have one that's going to approve it. They reach out to the HOA, get all the questionnaire filled out, and then as long as everything adds up, all the percentages, everything makes sense, then they get the approval, and it's just a regular conventional loan.
I guess I took a client out there, and we're looking for a condo because that's all they can afford at that time. And it was
Yep.
like, it was a nightmare.
Yeah.
Just trying to find somebody that would.
Yeah, some of these aren't approved. Just had one the other day. Just if we couldn't get it approved, it has to be non-warrantable.
Right.
Non-warrantable, you're gonna put 25% down versus
That was
the
the other thing, yeah.
FHA 3.5% down.
Are you talking about spot approval? Is it just for that one unit or is it for the whole complex?
For the ones, we're not going to approve the whole complex for Fannie Mae. Fannie Mae may put it on their list or whatnot,
Thanks, Sean, appreciate it.
but we're approving that condo.
That condo?
Yes. So, all right, non-QM. This is where things get creative. What does non-QM stand for? Non-qualifying mortgage. Examples of a non-QM would be something like a bank statement loan. All right. We got away from the whole stated income days. We're getting close, but there still has to be something, right? There's the bank statement loan where we can do 1 year bank statements for someone who's been in business but tends to write off a lot on their taxes and not show income. But their bank statements show $200,000 a year in income, and we hit them with a percentage for expenses and give them a qualifying number. So there's bank statement loans. There's also some asset type loans where if they were to put 20 or 30% down, if they have 12 months in reserves, then we'd qualify them just on that. All right, they got good credit. Similar to something like a DSCR loan. Anybody know what's a DSCR loan?
I was just about to ask you about, we all have that.
Oh yeah, we got smoking rates on them too. So,
What's some of the rates you see?
huh?
What's some of the rates you see?
Oh, we can get into the high sixes, low sevens on DSCRs right now,
7 and 8 this morning.
right there.
With how much put it down?
Let's get to that. So DSCR means, what does DSCR stand for?
Service coverage ratio.
Exactly.
So
What does that mean?
the property what to say, it's not like, you don't need no loan docs, you don't need, income docs, it's, how can you say, I don't know the exact.
They basically want to make sure that you could rent this home for more than what the mortgage is,
Yeah.
right? So they're gonna appraise the property, they're gonna appraise what it'll rent for at the same time, and then based on your mortgage, there is a ratio. And if you're at a 1.25 or higher, you're in great shape. Meaning that that thing will rent for 1.25% more than what your mortgage costs are. And you're gonna find anybody that, you gotta have okay credit. Better the credit, the better the ratio, the more you put down, the better the rate. Also, you can play with these prepayment penalties, okay? We don't get prepayment penalties in regular mortgages. That went away. But in non-qualifying, they can start working that back in. And in the DSCR world, they'll go with a 3-year or even a 5-year. All right, so if you go, and some of them will be like a 5, 4, 3, 2, 1, meaning there's less of a penalty every year. So if you get 3 years into a 5-year prepayment penalty, you're gonna pay less. You only got 2 years of penalty to pay, and it might be worth it to go with a different rate. But if you have stellar credit, over 1.25, over 20%, 20% down at least, that's where you're getting down to the 7 and 8 or even in the 6s right now. You get a lower ratio, you go under 1, then your rate's gonna just start shooting up. So if your mortgage costs are $3,000 a month and you're renting it for $2,750, it can still be done through a DSCR, but your rate's gonna be 8 to 9%. So we can use that same DSCR, we can use it for foreign nationals, foreign investors can do that. They can come in and do DSCRs all day long.
What was the DSCR, the debt service?
Debt service coverage ratio.
Do you have any grant programs in Nevada?
Yeah, so we got Nevada Housing. It's funny. So they did away with the one where it was a forgivable after 7 years. There's still a non-repayable 30-year grant for first-time home buyers where they don't have to make a payment, but if they sell that sucker before it hits that 30-year mark, before it's paid off, they gotta pay it back. Okay, teachers, there's a great teacher program here on the Nevada Housing that they get a little better rate and they get a $7,500 forgivable grant. And that's over 3 years, I believe. And that one is, again, it's less each year you have it, the less you pay back, it's prorated. So
How about the
that's what-
nurses and the police?
Nurses and police don't have a special one, it's just the teachers.
Okay.
And that's with not having a house.
Teachers, they don't have to be first-time home buyers.
So you do it as a second.
Yeah, anybody can do the down payment assistance, regardless of being first-time home buyers or not. There's multiple products out there. Nevada Housing has different debt-to-income ratio requirements. Can be 45% if it's a 640 or higher credit score. Can be 50% if you're over 680. They have limits on income. But we do have other products. We have an internal EPA program that doesn't have any income limits. And that
Credit.
credit, again, Nevada Housing is 640 or higher. I believe our internal one is 660 or higher, but we do have a national down payment assistance program that's 600 or higher,
Yeah.
okay? So there's all kinds of products available.
And all these products, you have to still qualify for that, as that interest.
Yeah, you
rate.
still have to qualify as a normal FHA or even conventional, depending on what's available. So yeah, EPA, down payment assistance. They're talking, yeah, we're not gonna get that. We're not getting politics. We're gonna do a hard stop on that. But, yeah, so non-QMs, basically we live by, if they can afford the payment, we can find a product. The product's out there. It's just, each lender's limited with their product, whatever they have in products and overlays. I haven't found a limitation yet. Okay, so. Seller concession cheat sheet. Conventional is a confusing one, right?
Yeah.
Okay, if they're putting less than 10% down, they can only get 3% seller concessions. Recently, they changed that to where they're not counting agent compensation towards a concession. So you technically get 6% out of the seller on a 5% loan, as long as 3% of that is going towards your compensation,
Gotcha.
okay? If you get over 10% down, you can ask for 6%, and if you go over 25%, if you can find a seller that's willing to give you 9% seller concessions, absolutely ask for it. Investments, if it's an investment, they have to put down 15% or more, but they can get a max of 2% seller concessions. These are conventional. FHA, and any of these flyers I can have branded for you with your information on them, this cheat sheet especially, you should have that, especially when you're sitting down in your buyer consultation so they know what they can do. FHA 3.5%, you can get 6% seller concessions. So that's cool. VA, this one's the gray. It says 4% and you ask any lender, average lender, at least 80% or more of them are gonna tell you the max percentage of seller concessions on VA is 4%. All right, what does that 4% stand for? That 4% means that you can get up to 2 permanent discount points, 2%, towards buying down the rate permanently, and up to 2% can go towards paying off personal debt. It's the only loan that allows you to pay off personal debt with seller concessions. So that's the 4% they're talking about. But in the guidelines, it says whatever the underwriter doesn't deem excessive. All right? For VA, the underwriter, as long as it's not excessive, can approve. Sky's the limit, right? So what's happening right now in this current market? You guys heard of the 2-1 buy down? It's a temporary buy down versus a permanent buy down. And it's over 2 points. Right? It's like 2.3. That's about what you can calculate for a 2-1 buy down. 2.3 of the loan amount. So if we've already asked for 2 points permanent, and we've already asked for 2% towards seller concession, and 2-1 buy downs are being done, so we can get one of those. Where are we at? We're at 6.3 now. All right? And let's say there's still another $7,000 in normal costs. All right, we got a $400,000 loan, so we want another $7,000 covered. We're all the way to 8%. All those things are not excessive. So yeah, we can, a lot of times the seller agent will call me and says, hey, you asked for 6% on a VA. I'm like, yeah, I can spend it. Right? We can make it happen. So 2-1 buy down is great in this market. Again, If the buyer has to pay for himself, most lenders won't do it. They won't allow you to. We can.
Oh.
Buyer can pay for it.
Wow.
They wanna postpone their payment, that's good on them, right? But
Say it again.
if basically what this does, let's say the 2-1 buy down, let's say $400,000 loan. 2-1 buy down is probably gonna cost about a little over 9,000. They take that 9,000, they put it in an escrow account. And each month, it draws, let's say for the first year, you're drawing $300 a month from that escrow account, because your payment is $300 less a month, because you're based not on a 7%, but a 5% rate for the first year.
Gotcha.
It's still a fixed lump for 30 years. We're just messing with the first 2 years. And we're giving you a reprieve. Why does this loan make sense in this market?
Cause that's what you're qualifying.
Well, these rates are probably gonna go down 2% over the next 2 years, right? So if you don't ever wanna see 7%, and you go with a 2-1 buy down, your first year's at 5. And then it bumps up to 6. We're gonna be at 6 after that 1 year. So there's where the difference is in permanent and temporary buy down. At the end of that year, on this particular example, there's still $1,936 in that escrow account. And if we refinance it, what happens to that money?
They give you.
Well, technically, we can't write them a check. It can go towards principal, it can go towards closing costs or anything like that if there are, but it comes back to them. All right, permanent buy down, that's gone. Those 2 points they used to buy down the rate 6 months ago and paid $8,000 to do it, it's gone. They saved them $50 a month or maybe $100 a month for 6 months, and that $8,000 is in the trash. That's why we don't want to pay to buy down the rate permanently right now. So 2-1 is a great option for now. About 3 years probably won't make sense. Probably won't make sense because just the rate movement won't happen as much. We know there's a lot of room to go. So that's why it makes sense, even a 3-2-1. There are builders out there offering 3-2-1 buy downs. So,
What do you expect the rate to be in the beginning of next year, first quarter?
next year, first quarter, I would say our conventionals are gonna be in the high 5s. FHA might be in the high 4s. VA, low 5s.
Are they doing rate reductions this year? I know you already pre-do
They're
it, but
talking about 8 different cuts over the next 18 months. So it's gonna happen a lot. They got a long, they rose quite a bit, so they got a lot to cut. Here's that seller fund permanent buy down. Again, the money you pay to change your rate, let's say this one, we went 1 point on a $500,000 loan. That's $5,000 just to get 6.75 to save us $79. Okay, that's gone in 6 months, guaranteed. It's gone because we're gonna refinance it. And there's a rate rebound flyer in your pamphlet. That rate rebound means that we'll refi and we'll cover loan costs plus $1,000 towards third-party costs for the next 5 years. Every 6 months, as long as it drops at least 0.5%, we can do it. So we can do several times. Gifts,
So you saying like the third party, right?
like title and escrow.
Gotcha.
So,
So they'll most likely just come out their pocket for appraisal?
yeah, so what's great is we service most of our loans, pretty much all of them. And if we're still servicing a loan, there was a short period during this crappy market that we were selling them because servicing was losing money. So we sold them for like 6 months, I believe. But then we're back to holding everything. If we have the escrow account in-house and we can just transfer the money to the new loan, they're winning. Worst case scenario, they have to write a check for $3,000 to refill their escrow account at closing. And then they get a check back for $3,000 from the old escrow account that they emptied out for you. So it's pretty much a wash.
Gotcha.
All right. Gifts, gift of equity. What's a gift of equity?
like buying your parents' house and
I mean, almost, right? Parents, okay? Blood, like first. I don't even think your brothers. Ricky, can your brother or sister give you gift equity?
Yes, Diesel.
I think so. But
What,
can't get outside of that.
Immediate family.
Yeah, it's in the house, right? What's another situation where you get a gift of equity? It's in writing. Lease purchase. Make sure it's in there, how much is going towards your down payment. Cause that's what we're talking about, down payment. There has to be a minimum investment for a buyer, and that comes from the down payment. The only people that can help is whether you're getting a gift from a relative, you're getting a gift of equity, or coming from the person you leased it from. If it says it in the lease contract, says, yeah, your rent, $500 every month is going back towards your down payment. Cool, then we can count that. Gift funds, this one's fun. An interested party, interested third parties. What's an interested third party?
Somebody that's investing.
You. You're the agent. You're a third party. All right. Lenders, agents, escrow, anybody involved in the transaction that's not party to the transaction is a third party. So when you gift some of your commission, what does it go towards? Closing costs. That's all you can do. You can gift all your commission towards closing costs if you want. Just can't gift it towards their down payment. When can you gift it towards their down payment?
To your child.
Your child. To a relative. Okay. On FHA. Conventional, you can't. Found that one out the hard way. I still close that sucker, but we had to do some fancy dancing. All right. Conventional does not allow the agent to gift it to their family. Okay. So just know that. These are the tricks.
Yeah, that's why sometimes you have to convert from a conventional to an FHA.
Yeah.
Because of that.
But gift funds, conventional can come from your uncle, your uncle's wife, your sister's husband, your sister's husband's dad. There just has to be some tie to relation, somewhat.
Yeah, we had to do Facebook relations. We were doing, because they had to show that there was an interest in the underwriter. I'm like, okay.
Oh, yeah.
Yeah, we had to make sure that they were that close.
Oh, yes. An old assistant of mine emails me every year on the anniversary of this certain deal. The underwriter wanted to know what it meant. She wanted documentation that they were really good friends.
Yes.
Okay.
Yep.
Meaning friends from high school, all this time, whatever.
Yep.
He sent the underwriter a picture of the two of them in a bar having beers. He said, "Does this work?" It's the funniest thing I've ever seen in this business. And he did it as a joke. But underwriters don't have a sense of humor. FHA, different game again. They can't be, they're still gonna be your mom, dad, grandparents, has to be that type of family. Okay, you can't use brother-in-law or get too far out. If you have someone giving you money outside of the bloodline, then you're looking at 25% back.
How about, I've seen where they had like a church. Church can.
Your company that you work
your
for
company,
can. Yeah. There's a lot of things when you look at the conventional side, the FHA, yeah, they don't like it.
Yep.
They're gonna make sure. Early payoff hacks. This is cool. If you pay one extra payment a year, just one, you can take a 30-year duration down to 24 years. And it's amazing how much that 6-year difference saves you on a, what was it, $475,000 loan. If you pay it off 6 years early, you're saving $156,000 in interest. It's quite a bit. A lot of people ask about this, paying bi-monthly instead of monthly. just start doing it.
They hold it in reserve.
The servicer needs to know, otherwise you're gonna get hit with late fees, okay? A lot of times we do this up front, or if you're gonna change it later down the road, they have to reach out to the servicer and have it set up to do so. And then they can do it. Then they just cut up their payment in half, pay half on the first, half on the 15th, and just don't miss, because if you miss and it's late, still. This one, again, same price, $475, 6 years, save 6 years on the loan, and $168,000. So there's hacks and ways to do it. Why don't people do this?
I don't know.
Some don't know about it, and some just,
Some don't know about it.
some just can't function that way.
Right.
Just make-
And the others that can are like, oh, what if I send that $3,000 and I need it next month?
Right.
Right? So, we have a product for that, but that's a completely different class. Really like it. Quick qualification hack. Write this down. Person wants to have a max monthly payment of $3,100. Multiply that by 135. That's gonna ballpark them a purchase price, or a loan amount. All right, 418 loan amount. They're gonna do an FHA, 3.5% down. Probably gonna be about, what, 430, 440, somewhere in there for a purchase price. But this will give you a loan amount. So if they had 80,000 to put down, 418,000, they're looking at a max purchase price of 498. So people don't understand how far their money can go right now. They come to you, they're paying rent for $2,400 a month on a 4-bedroom home. So they're gonna expect a 4-bedroom home with a pool for $2,500 a month. And when you do this, and you say, okay, we're gonna multiply 2,500 a month times 135, what is that? What's 2,500 times 135? You know? Loan amount's 337. Is there a lot of 4 bedrooms with a pool for 337? No. So now they're like, oh, I wanted to spend 2,500, but I can spend more. So that's a good, quick way to kind of familiarize them with the current market, current landscape. Here's some questions to ask. On a scale of 1 to 10, how is your credit? The people with good credit are just gonna come right out. Oh my gosh, we're in the 800s. You don't have to worry about that. The ones say, well, when they say well, or if they look at you and pause, that could be an issue. These are questions you're gonna wanna ask them as you're getting involved with showing homes.
There was this one time in Las Vegas.
Oh, or we've been working with a credit counselor, so, or, well, credit-wise
My
said.
divorce.
Credit Karma.
Credit Karma tells me, oh gosh,
I'm a 4,000.
yeah. So just know that when people are looking at Credit Karma and even the Equifax app and stuff like that, those are raw scores, right? There is a different scoring algorithm for mortgages, cars, retail, everything has a different algorithm. So when they went and pulled their credit simultaneously at a car lot and a mortgage, it's gonna be 2 different scores. Okay, they score them completely different. So when someone's just looking at Credit Karma, they're looking at a raw score, and their actual score for a mortgage probably gonna be lower.
I have a question. Somebody who's been on disability for most of the year, and how long do they have to be back at the job? Is it just one month of paychecks?
How long off?
8 months.
8 months. Conventional doesn't have a time limit. FHA has a 6-month time limit, but even then they want a letter of explanation and whatnot.
Right.
Now the biggest thing is do we have a 2-year work history? Did they go back to the same job?
Right.
You know, same can be said about someone on maternity leave that had a child and was off for 6 or 8 months and then they went back to work. As soon as they go back to work and start getting pay stubs, we're good to go.
So do you have to have one month's worth, or is it just
Yeah,
one paycheck?
month's worth.
It's one, okay.
So, that good segue into the income sources. W-2, obviously that's easy. On W-2, if they're hourly, make sure that in this process, if they've been up and down in their hours, make sure they're doing a hard 40 until this thing closes. Because if we get a pay stub, and let's say the underwriter signs off on it, and then we get an updated pay stub before we close and it has 39.8 hours, boom, just shot everything to heck. Now we gotta go on a variable scale and the average income, and now that person's not gonna have enough to qualify. That's a big killer for us, variable income. And underwriters used to be very lenient, but Fannie's sending a lot of deals back right now. They're not playing games.
John, quick question for you. When you go, on your questions, when you go down through those questions with clients, they'll send them to you and you go down through those questions, and you give them a pre-approval.
Mhm.
Has that gone through underwriting? Or
Not
do
an
you-
underwriter,
Just does.
Automated underwriting?
automated underwriting, because all an underwriter's gonna do is take those findings from the automated underwriting system and make sure they're in the file.
But see, I've been through it where lenders will just put anything in there, like he's got tons of assets,
Right.
it's
Yes.
whatever the lender puts into
Yeah.
the system or the processor puts in the system, it's gonna spit out the DU. Those facts have to be facts, not fiction.
Yeah.
So, when you're on the listing side and somebody gives you a DU, but are these his real assets? Cause
That's what you want to
Right.
know.
Yeah.
or his real income,
That's what I was
You wanna
getting
know
at.
how you can tell?
I really wanna know.
Even numbers.
right?
They
So-
just put something in.
Yeah, that's, cause you run it sometimes just to see what it's gonna
Yeah.
give you
Yeah, they
until
say,
you get
I've
it
got
approval.
$5,000 in the bank. Nobody has just $5,000.
Right.
It's
Right.
like 5003.14, but loan officers don't do that.
Right,
John does, our guys do,
right.
but we'll see DUs with 10,000, and they get a statement and it's like $8,984, deal's dead.
Yeah.
Cause that DU was ran with those numbers.
Yeah,
Yeah,
and so run with whatever you
The
tell them.
quality of your DU
Yeah.
finding is directly rated with the quality of data you put into it.
That's
I
right.
can make something.
Yeah, you
give
can
me
make it,
approval,
you can make it get the
That
approval.
doesn't mean
And
I'm
I
gonna
feel
get
great.
approval.
Right, I know.
Like, you feel good?
Yeah,
And once that income goes to the underwriter, that's the person's like, they're gonna actually look at the income and make sure that it's actual
Well-
compared to what you put into DU. And if it changes, they run DU, all of a sudden, hey, we're suspending this file, you're over your DTI.
just like the nurses, this is the big thing, the ones that were on contracts, you know, they're doing, and here they're getting all this money, but it's really, you can't even use it.
It's a challenge.
It varied, I mean, we
And
couldn't approve
we-
nurses who were making all these gobs of
Here's the
money.
cool thing, we now have an internal nurse program.
Oh, yeah?
Yep.
Yeah, because all those
Our
contracted,
calculating income is based on the last 6 months to a year.
because a lot of it's stipend.
Mhm.
So, you know, they're getting, you know, food, housing with stipends, and that was not considered their income.
Yep.
So are they able to use the stipend?
Mhm.
No, yeah, see,
It's
you're
up to
still,
you to live.
yeah, we couldn't
We're
approve this
just
one,
on
she goes, but I
hourly.
make all this, yeah, but I'm sorry, but it's stipend money, it's not,
It's always gonna be variable,
yeah.
you know, because
Yeah.
they work up and down, but
Yep.
a lot of times it's like, hey, I'm just gonna approve you on the minimum, 72 hours. Okay, we're just gonna approve you on the minimum 72, it shows up in your work number, and shows up on your original letter that that's what you're scheduled to work, and if we can approve you on that, great, if not, we're gonna try and get creative, see what we can get squeezed in there, so. Self-employment, we talked about self-employment, 2 years taxes. If you have somebody self-employed and we're getting into tax season, have them have their accountant reach out to me and I'll help them. There's ways to get their income up without having them pay a fortune in taxes, as long as it's somewhat legitimate and the accountant's says that he can do that, then we're going to show them how we need to qualify. And I had this one person get all up in arms when I was helping him with his taxes, like, this is fraud. I'm like, what do you mean? He's like, this is fraud. I said, do you think Uncle Sam cares if you write off less expenses? They don't. They don't care. They'd rather you see you not expense anything. I said, so don't expense anything and you can buy a house. So it's not fraud. Social Security, retirement, 401k, IRA distributions. If they have a lot of money in their retirement and they can set up monthly distributions, we can use that for income.
But you have to be at a certain age though.
As long as you can set your, whatever age you need to be to set up distributions with your accounts, yeah. Trust income, I like this one, I've used it multiple times. A lot of lenders, most lenders, probably 98, 20, whatever percent of them don't know that if you put $300,000 into a trust account to pay yourself for the next 37 months, all of a sudden we just created $90,000 a month in, or, is that right? No, about $9,000 a month in income for you. No job, don't need a job history, good to go.
If you're not of age and the client has a 401k and they're not of age and they wanna use some of that toward their down payment.
Yep.
Can they do it without a penalty or with a penalty?
You don't get a penalty, you still have to pay fees for it. Like, you get penalized for drawing from your 401k early. You don't get penalized for using it for primary residence, but you're still gonna have to pay the fees and sometimes pay it back if it's loaned. And if it is loaned, then we have to consider the loan amount toward your debt to income ratio. So there's a lot of things that go into that. But yeah, you can use it for the purchase. So yeah, trust income, that's created. Child support and alimony, as long as they've received it for 6 months and they're set to receive it for the next 3 years, we can use it. If it's Social Security on a child that's 17 and it expires when they're 18, we can't use it.
Yeah, it's over.
Right. Departing residence, this has been this was a myth back in the day, where you had to rent it for 2 years to claim rent on it as income. But if you're leaving your home, let's say it's a conventional loan, and you're leaving this house to buy another one, you're gonna keep that home because it's got a 2.5 rate, you can make $800 a month on it, great. All we need is a lease signed, and we can use 75% of whatever you leased it for. So if it was $3,000 a month, we could use $2,250 as income.
Besides the lease, you have to have the deposit and all that.
If it's an
Deposit and-
FHA loan, yes. If it's a Freddie Mac loan, yes. If it's a Fannie Mae conventional, see how crazy these
I know,
different
I
these
know.
are? If it's a Fannie Mae conventional, all I need is a signed lease agreement that's not signed by your wife or son or someone with the last name, right? So then it's good to go. So, and they don't even get appraised. Cool thing, VA, you get 100% of what Zillow says that'll lease for. You don't even need a lease. You do need a property management company, but you get income for 100% of what Zillow says that could lease for. Literally. I'll send them a picture, screenshot of what Zillow says the rent estimate is.
Just VA.
Yeah, just VA. So. Again, if they can afford it, we can figure it out. There's so many products out there. We can get so creative. So someone comes to you and says their lender said no, they're out of the market. Ask them why. Ask them if they want a second opinion. You know, because we can do soft credit pulls so it doesn't hit their credit, just to kind of run numbers and scenarios and see where we're at. And in most cases, especially with our lower rates, we can get them in.
So with soft pull, it will not hurt their income.
It doesn't hit them for inquiry.
Okay.
It only gives us one credit report, TransUnion. So we can't run it, at this point, we can't run it through desktop underwriter. Yeah, we're almost to the point where we can. That's like right around the corner. So we're limited, but we can at least run some scenarios.
Gotcha.
So, all right.
And then also on debt, let's say you bought your mom a car but mom is making the payment, so you, how many, is it 1 year?
Yep,
Okay.
12 payments,
Yes,
consecutive.
yes.
Have to see 12 consecutive payments. Back when COVID hit and they did COVID relief and they skipped a couple payments on COVID because their car dealer was so nice and did it for them. Start over, 12 months after that. So yeah, 12 payments, and that's not just cars. You could be co-signed on a
Right,
house.
Right, right.
As long as we can prove someone else is making the payment for that debt, we can take it off. We don't have to count it towards your debt.
You know, what was funny is a lot of people when that COVID hit and they didn't have to make payments. And they stacked up that COVID money and they thought they was ready.
Yep.
Oh, that was a ding on their credit. It was like, so it knocked their credit score down
Yeah.
because they was late on their payments.
Yep. No, for
I was
sure.
like, it didn't necessitate that one, did they?
Yeah, credit is king, man. They say cash is king. No, credit will always be king.
Have they gotten rid of the medical and everything on the credit reports? I heard that they were getting rid of,
It doesn't score the same anymore. So
Okay.
it'll be on the report,
right,
but it doesn't score. And if you have like $20,000 in medical collections, we don't count that as needing to be
Right.
paid back.
right.
It's not a detriment. So.
Just non-medical is still, you count the payment.
And bankruptcy, I mentioned bankruptcy. If you're going through bankruptcy, even if you have to make one late payment, some of them will say you have to go late for us to file all this. Go one late and then start making your payments again, because you can qualify, as long as your credit's good enough in the sixes, you can qualify to get another home less than a year out of bankruptcy.
Nice.
But you have to have the credit, you're gonna pay a little more in rate. But don't just say, screw it, I'll try again here in 3 or 4 years. Your credit, just because it's a bankruptcy, doesn't kill your credit. It's the late payments that, while you were going through bankruptcy, that ruins your credit. So if you can get away with just doing that one late pay and just start paying again after they got it running, you're gonna be way ahead of the game.
A lot of great information.
Thank you, yeah.
Appreciate it.
All right,
Thank
you're
you.
welcome. And I think that QR code has my information, but I got information all over everything around here.
Do you have a business card?
You guys are just downstairs, right?
For that?
You guys are just downstairs?
Yeah, we have an office inside.
Okay.
Thanks, John.
You're welcome.
Take care.
There you go.
Thank you. Yeah, I have to start everything back up because all my clients are in California, so I gotta start all anew, but still waiting. God, the board is forever getting my application done.
I couldn't imagine going down there.
Ugh. Now, on the reason why I was asking, my husband's on disability. We moved here 4 years ago and we sold our house in California. But the last 8 months, he's been on disability
Yeah.
for his shoulder, cause he's he's an electrician, commercial electrician, and he can't do overhead, he's did torn rotator cuff.
Yeah.
Anyways, so he'll be going back to work, so he's hourly, but he makes like $85 an hour. Are you going to, how are you gonna calculate the 8 months of disability, cause he's on California disability?
Right.
During that time, he gets a first paycheck, are you going
Is
to
he going
average?
back into the same line?
Yes,
Is it
yes,
the same
it's going back to,
company?
well, it's not, well, yes, no, he's union.
Okay.
So,
Oh gosh,
yeah,
unions are
yeah,
fine.
yeah.
Yeah.
Yeah, but he usually stays with the same, it's like Redwood or, he's up in the Bay Area, so he works in California.
Yeah.
So, he'll be going, so are we gonna average let's say
We're
the
not
4 months
averaging.
left?
No, we wouldn't average the
So if
disability.
okay, 'cause
We would qualify him on his hourly rate.
Okay.
If he goes back to work.
okay,
So.
Alright.
Do you wanna see how we really get loans out?
what system do you guys use? Yeah.
So I had an underwriter send me a decline, I made that like 10 years ago, and I sent her back that. HR calls me. Ricky, that wasn't funny. I thought it was
I
hilarious.
thought, yeah. Well, I like the one, the skit where, you have everybody in a rowboat, and then you say, you know, everybody's supposed to be rowing and out, and then they're all going all different directions and not going nowhere, you know, from Realtor all the way to the Linder.
Totally.
And I love it because it's exactly,
It's what it is.
what it is. Everybody's batting each other going
That's
different
hilarious.
directions. But yeah, I get back into this business and everything. So I've been out of that because I quit this company I was processing for. They were horrible.
Yeah.
Horrible. I lasted 2 months and I was the longest processor to stay with them.
That's bad.
Yeah, they were doing New Jersey and Pennsylvania loans.
Mm.
Oh
Mm.
my God! And, well, they do a lot of DPA
Mhm.
and DSCR loans,
Mm.
and they were just micromanaged to no end. And I said, you know what, you guys can take this job and shove it, because I do not need to be micromanaged. I know how to do my job.
Yeah.
And, you know, you don't have to, daily meetings, going over every single condition or things. I'm like, come on, yeah, I'm sorry.
Adds
And
another
this
2
guy was-
hours to
Yeah, and I'm
process
like,
it.
and then why aren't you getting your work done? Well, I
I
don't
wonder.
know, I wonder why.
I was
you
here
know.
for 2 hours.
Exactly. So, yeah, I just said, you know what, forget it. So then I told my husband, oh, okay, I'll just go back into the real estate.
Yeah, you know, I actually love this, but if my wife worked and I could actually go do real estate right now, like especially right now, I would 100% get into it. Because I think the buyer's agents are in trouble. They don't know how to sell their own commission.
Right.
Right? I
Right.
really think they're in trouble. So
Yeah.
the ones that are fearless and will get those forms signed, they're
Right.
gonna kill it.
Right.
It's the ones who will go show a house without it because the person kind of gave them a
Right.
hard time.
Right.
They're gonna.
Yeah, you could be working for nothing.
Yeah,
I mean,
you will.
yeah.
But I'm not about that life.
Oh, no. Yeah.
What's that origination? It's how I get paid. Did you see my car?
Right. Exactly. My little Malibu.
Yeah.
With 232,000 miles on it. That's how I get around.
Yeah.
But yeah, I just I haven't worked in 9 months, you know, in any.
Since you've been here or what? Or
Oh,
just
well-
got license done?
Well, I got all my licensing, so I haven't done any business here in Nevada.
Yeah.
I have a California real estate license. I renewed there because I just never know. I have 2 kids still in California, so
Yeah.
I may get a broker in California.
Yeah.
But for here, we've been here for almost 4 years.
4 years. Okay.
And I was doing, you know, out of my house. And I was doing all the refis and when I was in California, especially the VA Earls. Oh my God.
It's money in the bank.
Oh
It's
my
easy.
God. It was awesome.
Just stack 'em up.
But, yeah. Well, I was processing him, but
Yeah.
the lender, he lived in Escondido, which is by the base.
Mm.
So he really, I mean,
10 a month.
here COVID is, and my sister like, you gotta go to the store, they're gonna do this, and I'm like, they're gonna shut everything down. I go, I don't have time.
Yeah.
Because
you
I
don't.
literally was
Yeah.
I was working like 16-hour days
Oh, yeah.
processing, because even though there's no qual, you know, it's easy peasy, but
Oh,
it was
yeah.
just a lot of,
My team, my personal team did that year 280 million.
yeah.
Uh,
I don't know how many, but see, yeah,
I was like,
well, we were doing like San Diego properties, so,
Ooh.
so it
Ooh.
was
Big
quite,
ones.
yes, it was quite interesting, so.
That's awesome.
But, yeah, I've gone through, but I've been in real estate since 2000, so
Oh, okay.
2000. But I have been out of the real estate side,
Yeah.
selling for
Yeah.
at least 9 years.
No, okay.
So I gotta get back into it.
Get back in, get feet
Yeah,
wet,
yeah,
get some leads going,
Yeah.
throw up a couple Facebook
I-
ads, you know what I mean?
I just can't wait for my license, because
Yeah,
it's like taking
yeah.
forever.
Yeah, we
6 to 8
teach
weeks.
we teach Facebook ad stuff too. So
Yeah, because
if
I'm
you-
not
if you're-
really good on Facebook.
Yeah.
I had to get a Facebook and I had to get
we
Instagram.
gotta get ads going from somewhere, right?
Yeah.
Get leads.
Right,
Yeah.
right, so I'm like, okay, so, but I'm a big farmer, I love to farm, so.
So, pro tip for you is to pull if you're gonna farm, pick your areas.
Yep.
Go to title,
Yep.
get a list of
Yep.
all the people,
Yep.
have it reverse searched for their emails, throw those into Facebook, and do your retargeting campaign in that farm.
Right,
So then when they see your flyer, they
Right.
already know who you are.
Right.
They've been seeing you all over Facebook.
right.
And
So I gotta
it's
figure all
actually
that out,
pretty
cause I'm not good at that part of it.
It's not
Because
hard.
in when I was, my son, when he was little, we used to go around in a stroller, put my stuff in, like, we had
That's awesome.
calendars,
Yep.
notepads,
Hey.
just informational for their community, and I did 1,000 homes.
Wow.
And I really
Just
moved in that area,
referral.
until this one agent came in, he was Mr. I will
Yeah,
walk in your
so-
house and tell your, this contract is signed, kind of pressure, and I'm not a pressure.
No, from them.
He kind of beat me out
Oh,
on
okay.
some of them, but, you know, people that, even the little kids, they're going, you know, my kids were in soccer, they're going,
That's
you're
all I
in
can
my
think of.
refrigerator, it's my calendar,
Yeah.
you know? So, it was, I like love
No,
stuff,
Raquel
but
is up
you
there
know,
watching.
Facebook
Like,
stuff,
it's-
Instagram
we're
stuff,
solid.
I'm like, that's gonna be hard, that's my hard part.
Very cool.
Anyways, well, thank you, and I'm
Nice
gonna thank
meeting
you for the card,
Yeah,
and,
Yeah,
once
so
I
you already got it, right?
get into business.
Okay,
Absolutely.
Alright, thank you.
You're welcome.
okay. Awesome. Yeah, no, we're set. You're amazing.